there are several managerial decisions which can actually impact the organization's productivity a lot. One of those which really can matter and make a significant difference to the organization is increasing inventory turns. While doing my workshops, very often I've seen that this question does create a lot of excitement, and people understand that this is something which is within their control, but it's not easy. What I'll do is that try to explain the concept of inventory turns first. Consider a person A who has 1,000 rupees with him. What he does is that he buys 10 shirts from it with that money, and he sells every one of them for 150 rupees. So he makes so his total selling price is 1,500 rupees. He can do this in 4 hours. So what he does is that with this money, now he quickly goes back. Again, he buys shirts worth rupees 1,000. He sells that at 150, 10 of them, 10 shirts worth 1,000, and he again makes 1,500 rupees in the next 4 hours. So overall, in the day, this person makes 3,000 rupees, and his total spend is of 2,000 rupees. Understand that this 1,000 which came, it's really not an investment that he made into or over and above. He actually got this money from here. So he sold the money, sold it at 1,000 rupees. He sold his stock at 1,500, keeping the 500 rupees with him. With that next 1,000, he again did this. So it is not actually 2,000. It is with the 1,000 only he has made his margins of 3,000. Now this is where the concept of inventory turn plays. Another person, consider a person B. In a similar situation, for 1,000 rupees he buys 10 stuff, he sells it at 150, he earns 1,500 rupees. But instead of 4 hours, he does this in 4 days. And then again, after 4 days, having liquidated it, he again takes the 1,000, and again the story repeats. So here, what happened is that this person will earn 3,000 rupees, and he has spent how much? He has spent more than 1,000 rupees, because for rotating this money he has taken a longer time. So if I take it in everyday parlance, he has actually spent 2,000 rupees, and he earned the same amount of money, whereas in our case, in the first case, the person actually spent only 1,000 rupees. He invested only 1,000 rupees, and he earned his 3,000. Here the person has nearly invested 2,000 rupees, and he earned 3,000. So if you see the effective rate, so in a day, this person, the first person in a day, he earns 2,000 rupees, whereas the second person in 8 days earns the same 2,000 rupees. Okay, assuming here again he might have rotated the money. So which is better? Obviously, we all know this is a better scenario. Now, this is the concept of inventory turns, where with the same amount of inventory, how quickly and how effectively you can turn it over so that it gives you better results. Now, in an organization, how do you find out the inventory turns? Inventory turns, as the name suggests, inventory turns is found out by calculating the cost of goods sold divided by the inventory holding. Okay, so the cost of goods sold, you get this number from the profit and loss statement, and inventory holding, you get this from the balance sheet. So when you do this, you'll get a number, and that particular number is the number of turns that the particular inventory has taken. So therefore, in case we have an organization where there are 4 inventory turns, so how long did it take for the inventory to so what's the average inventory holding? How many days so inventory holding in days of stock is equal to, we do 365 divided by 4, whatever be that number, around 91 days. Managerial processes which reduce this 91 days substantially can improve organization 2 ways. First is by reducing the amount which is locked in as capital, as we saw in the first example in the case of A, and second, by rotating stocks faster. By rotating stocks faster, you earn more revenues and you gain a lot. Take the example now. Inventory turns also depends a lot on the industry that the organization is in. Now take the example of Walmart, a retailing giant. If you do the same calculation there for Walmart, you will see that the inventory turns of this organization is around 8.3. You do that for a large manufacturing organization, which is say into steel or aluminium kind of a thing, you will see that the inventory turns is around 3. Now here comes the outlier in this whole thing. If you do the same thing for Toyota, an organization which is into manufacturing cars, automobiles, you'll see the inventory turn is 10. This is where Toyota scores, because if your inventory turns are 10, that means with lesser capital, as we saw in the first case here, you are able to generate higher revenue. Better inventory turns ensures that your organization is more productive in nature. Now, with the same old processes, can you achieve any amount of inventory turns? No, you can't. So the important thing is managerial processes and decision making are very important for getting the inventory turns increased year on year. Remember one thing, that if you try to do increased inventory turns with the same processes that you have today in place, it will literally be impossible to do it. So Walmart went to the modes of cross-stocking, also pushing on a lot of information systems so that the information flows on to the vendors directly. So a lot of things need to happen. In case of Toyota, they would have done similar systems to increase the inventory turns. Be very conscious on the inventory turns. Look at it. Try to increase inventory turns. You reduce the capital requirement of the organization as well as churn out your goods faster, which means you need to have a better handle on what your customers are asking for as well. So do turn inventories as often as you can and monitor this number carefully.